Wall Street just pulled off the biggest market manipulation you've never heard about, and I can prove it with one simple chart. On April 7th, Trump announced a ceasefire with Iran. Markets went crazy the next day. The S&P jumped 2.5%, Nasdaq almost 3%. Investors everywhere were celebrating. But here's the problem. The ceasefire wasn't real. It was falling apart in real time. So what actually happened? To understand this, we need to rewind to February. The US and Israel bombed Iran, supreme leader killed. Iran shut down a critical shipping channel, and Wall Street absolutely panicked. The S&P tanked 9%. Retirement accounts got decimated. But worst of all, hedge funds were selling at the fastest pace in 13 years. Leverage hit all-time highs, short positions everywhere. These guys were terrified. One analyst literally said we'd need to cut 15 million barrels of oil daily. Brent would hit $250, $300 a barrel. A depression, not a recession. Everyone was bearish, and I mean everyone. So April 8th comes, markets rip. 400 stocks turn green. Oil crashes 13 to 16% in a single day. Mainstream financial media says, relief rally, world peace. But wait, according to satellite data analysis, only 5 cargo ships moved through the strait. That's a 96% drop from normal traffic. If there's 96% less trade happening, how can there be world peace? Something's not adding up. The real reason isn't peace, it's something far more mechanical. This is a short squeeze. Here's how it works. Traders borrowed stock to bet it would fall. It didn't. Prices started rising instead. When losses get too big, brokers force them to buy back those shares. They all buy at once. That buying drives prices up, which triggers more forced buying. It's a chain reaction, a mechanical avalanche that has nothing to do with fundamentals or peace. But that's just the first domino. Once stocks ripped, algorithms kicked in. Goldman reported CTAs, computerized trading systems, were sitting on a huge short bet. When the S&P crossed certain price levels, their algorithms automatically flipped to long. No thinking, just rules. They bought $86 billion worth of stock in 5 days. That's a top 5 buying speed in history. Then came Domino 3, the options market. Dealers hedge by buying stock when option prices spike. Dealers bought more. Prices went up more. More buying. It's self-reinforcing. Here's what's actually happening in 2026. The stock market you think you know is gone. 63% of all U.S. stock funds are now passive indexers. $13 trillion in blind money that doesn't read earnings, doesn't care about fundamentals. It just buys the index on autopilot. The bigger a company gets, the more these algorithms buy it. That's why the Magnificent Seven owns a third of the S&P. What's left of active investing? Giant hedge funds running at 4 to 8 times leverage with strict drawdown rules. When they hit those limits, they don't debate, they sell immediately. And underneath it all, options trading. Same-day options make up 63% of all S&P volume. $2 trillion in notional value every peak day. Every single option trade forces a dealer to hedge in real time. The dominant players aren't analyzing valuations, they're reacting. This isn't new, this keeps happening. December 2018, Jerome Powell says one word, patient, and the Dow explodes with its biggest single-day gain ever. August 2024, Bank of Japan hikes rates, yen carry trade unwinds, Nikkei crashes 12%, then bounces 10% the next day. Different catalysts, same mechanics, same outcome. Your investment account isn't responding to reality anymore, it's responding to this feedback loop. The stock market is now a giant feedback loop of algorithms, passive funds, and options dealers all reacting to each other in real time. The headlines, those are just narratives people use to rationalize what machines already did. If you're tired of traditional financial media giving you the dumbed-down version, if you actually want to understand what's moving markets, hit subscribe, because this is the stuff they conveniently forget to cover, and it's the only way to actually understand what's happening with your money.